Hey everyone, welcome to another deep dive. We've got some really interesting source material lined up today about a topic that's, well, pretty essential, investing basics.
Glad to be diving in. It's a topic a lot of people shy away from, but it doesn't have to be intimidating.
Right. We're going to break it down. And what struck me from what I was reading is that it's not about, like, getting rich quick schemes or anything.
Not at all. It's more about, being smart and protecting what you've earned, safeguarding your future.
Yeah, exactly. And one of the sources really drove home the point that it's about maintaining your purchasing power, basically.
Because imagine, right, your money in a few years, it could be buying you half as much stuff.
Ouch. That hurts.
That's inflation doing its thing.
Right. Things get more expensive. Your money just doesn't stretch as far. One source even mentioned how currencies tend to, inherently decrease in value over time.
It's true. And that's why investing in what are called real assets is so important.
Real assets.
They have this historical track record of generally increasing in value over time, kind of like keeping pace with or even outpacing inflation.
Ah, okay. So they hold their value better.
Yeah.
So what are some examples of these real assets?
Well, two of the most common and historically successful ones are stocks and bonds.
Okay, those sound familiar. In Spain, they call those renta variable and renta fija, right?
Exactly. And they both play different but important roles in a well-balanced portfolio, which I'm sure we'll get into.
Awesome. Looking forward to it. But first, there's this other thing this source talked about. Compound interest. Have you heard of this? It almost seems like magic.
Oh, compound interest is definitely where things get exciting. You're essentially earning returns on top of your return.
Okay, so it's not just the money you put in initially that's growing. It's like the growth is also growing.
Precisely. And it just keeps building on itself over time. It's like a snowball effect.
I like the sound of that. The source gave a really cool example, too. They said if you invested just $100 with a steady 7% annual return.
In 25 years, thanks to the magic of compounding, that could grow to over $800.
Whoa. That's way more than just letting it sit in a regular savings account.
For sure. If you were to just, say, save $100 per month without investing it anywhere, after 25 years, you'd have $30,000, which, don't get me wrong, is great, but...
It's nowhere near that $800 return from just that initial $100 investment.
Exactly. That right there illustrates the power of letting your money work for you over the long haul.
Okay, so compound interest, definitely a powerful tool in the investing world. But let's unpack those real assets we touched on, starting with stocks.
Right, or as they say in Spain, rent a variable. So when you buy a stock, you're basically buying a tiny ownership stake in that company.
You're like a mini executive.
Sort of, and like anything else you can buy or sell, the price of a stock fluctuates based on, good old supply and demand.
Okay, that makes sense. So if a company's doing well, more people want their stock, the price goes up.
Exactly. Investor optimism, positive news, all that can drive demand and bump up the price. But of course, the opposite is also true. Bad news or a shaky economy can make investors nervous and...
They sell, sell, sell.
Exactly, driving the price down. One of the sources used the example of what happened with Boeing and their 737 MAX issues. Remember that?
Oh, right, when those planes were grounded.
Yeah, it raised a lot of concerns about the company's safety record, their finances, the whole 9 yards, and investors got spooked.
So did the stock price plummet?
Big time. Many investors sold their shares, causing a significant drop in the stock price. It happens. It's a risk you take when investing in individual companies.
Okay, that's a little scary, but I guess that's part of how the market works. But there's good news for those of us who don't have, a ton of cash lying around to invest.
You're talking about fractional shares.
Yeah, you don't need to buy a whole share anymore.
Not at all. It's a total game changer for accessibility. Now, you can buy just a portion of a share, making it easier to, dip your toes into different companies or sectors without breaking the bank.
I love that. More accessible investing. And speaking of which, our source talked about funds, both managed funds and index funds, or, as they say in Spain, fondos gestionados and fondos indexados. What's the difference?
So in a managed fund, you basically have a professional fund manager, kind of like a captain steering the ship.
Okay, so they decide what to buy and sell.
Exactly. They're actively managing that fund, aiming for the best possible returns for the investors. But of course, all that expertise doesn't come cheap.
There's a fee.
Managed funds usually have higher fees compared to other options. It covers the manager's salary, the research, trading costs, all that jazz.
Gotcha. Makes sense. So then what about index funds?
Index funds take a different approach. They don't try to beat the market. They aim to, mirror it.
Mirror it. What does that even mean?
It means they follow a specific market index, like, say, the S&P 500, which is basically a basket of 500 of the largest U.S. companies.
Oh, okay. So if you invest in an S&P 500 index fund, you're basically investing in a tiny piece of all those companies.
Exactly. And because index funds are passively managed, meaning they're not constantly buying and selling, they tend to have lower fees, which makes them a really popular choice for a lot of investors, especially those who are just starting out.
Makes sense. Lower fees, more money in your pocket, or at least in your investment portfolio. And then there are ETFs. Was it exchange traded funds? Something like that.
Yep, ETFs. The source mentioned them as a really accessible entry point to index fund investing.
How so?
Well, ETFs share a lot of similarities with index funds. They track specific indices, just like we were talking about. But the key difference is that ETFs are traded on stock exchanges, just like, individual company stocks.
Where you can buy and sell them throughout the day.
Exactly, which is different from most mutual funds, which are usually bought or sold at the end of the trading day based on their calculated price. Plus, ETFs often have lower investment minimums.
So it's easier to get started, even if you don't have thousands of dollars to throw in right away.
Exactly. Like that example from the source where they talked about an index fund with a $3,000 minimum investment. Well, you can find ETFs out there with much lower entry points.
Nice. That's perfect for someone who can maybe only invest like $500 per month.
Absolutely. No need to wait around to save up a huge chunk of change. But even though ETFs offer that easy entry point, there are still some important things to keep in mind when you're choosing one.
Like what? Give me the inside scoop.
One key thing is whether an ETF focuses on accumulation or distribution of dividends. Or, as they might say it in Spain, accumulation versus distribution.
Okay, refresh my memory. What's the difference again? Dividends.
Yeah,
Those are like those payments companies send out to shareholders.
you got it. So an accumulation ETF takes any dividends it receives and automatically reinvests them back into the fund itself.
So it keeps growing and growing.
Precisely, which can lead to more growth over time, especially with that compounding effect we talked about. On the other hand, a distribution ETF pays those dividends directly out to you, the investor.
Okay, so it depends if you want the money now or if you want it to potentially grow more over time.
Got it. Right. And then another important factor to consider is the expense ratio.
Which is?
Basically, the annual fee you pay for owning that ETF, it's expressed as a percentage of your investment.
So lower is better.
You got it. Lower expense ratios mean more of your money is working for you rather than going toward fees.
All right, so we've covered a lot of ground here. The why, the what. We've talked about why investing is important, different investment types, even how to choose an ETF. But how do we actually, put all this into practice?
Well, that's the million-dollar question, isn't it?
Literally.
A good investment strategy, it really starts with understanding yourself. Your goals, your risk tolerance, how long you plan to invest. But one thing that's universally important is diversification.
Diversification. I feel like we've been hearing that word a lot.
And with good reason. It's like the golden rule of investing.
Don't put all your eggs in one basket.
Precisely. You want to spread your investments across different asset classes, different sectors of the economy, different geographic regions.
So if one investment goes south, you're not completely sunk.
Exactly. The source had a good point about geographic diversification. The U.S. stock market might seem huge.
It's not the only game in town.
Right. It actually only makes up about 65% of the global stock market.
So looking beyond U.S. borders is part of the diversification strategy.
It's essential. If you only invest in the U.S. market, you could be missing out on growth opportunities in other parts of the world, like emerging markets. Same goes for sectors.
Sectors, right. What are those again? Like different industries?
Exactly. Technology, healthcare, energy, consumer goods, all these different segments of the economy. And you don't want all your money concentrated in just one or two.
So don't put all your money in tech stocks just because they seem cool.
Exactly. What if something big happens? Some new technology disrupts everything, or new regulations come along. Your investments could take a hit.
Makes sense. Spread the risk. So stocks, bonds, geographic diversification, different sectors, anything else?
Well, it's all about finding the right balance between risk and reward, right? Stocks generally have the potential for higher returns,
Some
but
higher risk too, right? More volatile.
exactly. And that's where bonds come in. Bonds are generally considered less risky than stocks and can add some stability, especially during those times when the market gets a little rocky.
Okay, so how do you know what the right mix is? How much to put in stocks versus bonds?
Well, it really depends on your individual circumstances, your risk tolerance, your time horizon.
Time horizon meaning?
How long you plan to invest your money. If you have a longer time horizon, you can ride out those market ups and downs a little easier. The source mentioned a study by Vanguard that looked at this.
Vanguard, the investment company.
Yeah, they analyzed how different mixes of stocks and bonds have performed over time. And they found that historically, a portfolio with a larger percentage of stocks tends to yield higher returns over the long term.
But also more volatility in the short term.
Exactly. So if you're investing for the long haul, like for retirement, and you're comfortable with some bumps in the road, having a larger portion in stocks might be a good strategy.
Got it. So before I go putting all my money in stocks, what else do I need to know?
Before you even think about investing in anything, whether it's stocks, bonds, or anything else, there's one crucial step you need to take.
Okay, lay it on me.
Emergency fund. Make sure you have one.
An emergency fund. That's like having some cash set aside for a rainy day, right?
Exactly. You want enough to cover your essential living expenses for a few months, just in case something unexpected happens.
Like if you lose your job or have a medical emergency.
Exactly. You don't want to be forced to sell your investments at a loss because you need cash in a hurry.
So, emergency fund first.
Yeah.
Got it. Anything else I should be doing before I start investing?
The source also highlighted the importance of paying off any high interest debt.
Credit cards, things like that.
Right. Those high interest rates can really eat into any potential investment gains you might be making. It's like trying to run a race with an anchor tied to your leg.
Pay off the debt, build that emergency fund, then you're in good shape to invest.
You've got it. And remember, investing isn't just about picking stocks or bonds. It's about taking control of your financial future.
It's about building a life where you have more options and more freedom.
Absolutely. And, here's a final thought-provoking idea from the source. What if we thought of personal growth as an investment too?
Investing in yourself. Now, that's something I can get behind.
Right, whether it's learning new skills, expanding your knowledge, prioritizing your health, those are all forms of investment in your future.
And that, my friends, is something worth investing in. Thanks for joining us for this deep dive into investing basics.
It's been a pleasure.